Welcome back to another episode of the Beginner Day Trading YouTube channel. I appreciate you guys for being here. Please hit that thumbs up so we can continue to grow the channel and fight the almighty algorithm. Now, today we are going to be showing you how to properly trade stocks as a day trader. Now, I know a lot of these type of lessons, a lot of you find boring, but this particular lesson is going to be very important for you to get yourself going. Now, we have videos leading up to this point that gives you all sorts of information utilizing different brokerages. And today we're actually going to work inside WeBull because I believe WeBull is one of the simplest tools you can use. Well, I should say, brokerage apps you can use to day trade. Now, in the left corner here, you can see that I have my leverage ETFs that I like to trade daily. Along with that, on the left side, you can see tabs inside your Webull app. So you can see there's markets, there's stocks, there's the screener. You got custom things you can do. You can see paper trading, and paper trading we've spoken about. If you want to practice, you can go to that tab, and then you've got options. Okay, so we're going to be trading stocks, and stocks are one of the safest ways that you can actually trade. Uh, I would say when it comes to trading options, that's a little bit more advanced because you're dealing with time decay, which is also something that you would need prior practice on leading up to where we are now. Okay, so you can see at the bottom here, and I'm going to scroll this down a little bit. At the bottom, you can see the intervals, right? So right now we have NVDL, which is open, and the NVDL is a 2x leverage ETF that tracks the movement of NVIDIA. So, for example, if NVIDIA moves 10%, then NVDL is going to move 20%. Okay, so that's either direction. If it comes down 10%, this ETF comes down 20%. If it goes up 10%, it's going to go up 20%, so forth and so on. And for me, I like to trade stocks that actually move. And so when we talk Nvidia and Tesla, those are two of the most action-packed stocks you can actually trade. And so this is why I use NVDL and TSLL because that's going to give me more percentage of a move. Alongside that, I get to trade with smaller amounts of money. Not to say that you can't do that if you're buying the stock outright or if you buy fractional shares. So for example, if you've got, let's say, an account that's worth $200 and you want to trade $5 at a time, you can do that with fractional share trading inside of Webull. Okay, so that's very important to note. Now, let me make sure that I've got everything out I wanted to say before we get into this. And so let's go ahead and go. Now, I would say it's more important to start trading with an actual stock. Okay, so we'll go ahead and change this up to going with Nvidia outright so that we can let you guys see what's going on aside of me using these leverage ETFs. So I'm gonna look for Nvidia, and you can see I have their chart open. And so at the bottom, we've got our intervals here. And so for a quicker moving stock like Nvidia or Tesla, I like to go with the 1 minute or 5 minute chart. Now, if it's something slower to move, let's say like I don't know, a PayPal or SCHD, something like that, I may go with a 30 minute or even hour interval because these stocks move slow. But for the quicker ones that you want to capitalize on movement, you want to go with something like this. Now, also inside of Webull, there's a tab that's normally here that's called trade. Okay, so I'm gonna bring that up here because I have it detached. So you can see there's trade right here. And this is the classic trade view. Now, normally what I like to do is put a little line in here that would represent our support. So let's say we're looking at support in this particular case to be $128. And so maybe I'll wait until it comes down to the floor, buy in, and then in hopes of a bounce going back to the upside. Okay. Now, another thing that you'll find is, let me bring it back up, there's a stop loss here, right? So let's say if we got in right now at $128, we could set our stop loss to, let's say, $127. And that practically would be saying, I'm not willing to lose more than $1 off this trade. Okay. And then you also have take profit here. Okay. And so you can put something like 129. So you could put 127 and 129. So 127 is saying that I'm not losing, I'm not willing to lose more than a dollar or whatever it's going to be. But to the upside, I'm willing to take 41 cent in profit, for example. Okay. Now, as it pertains to this particular trade, if we want to get in right now, we could take all of this out. I mean, you could leave that too, but we could take all of this out, leave it here as market. Market means that you're gonna buy the stock right where it is right now. So if it's at 128.59 and we would go ahead and click buy, it's gonna go ahead and put an order in for us to get in right now. Now, another way you could get in is kind of using your mouse here, hover over where you want to buy. And so let's say, you know what? I want to buy this thing if it falls to 128, for example. So you could click there and then you would click buy one at 128. Okay. So let's go ahead and put our order in there. Let's say I want to buy in at 120, 128.18. And now, what you could do, if you're a little bit more patient or you think that this stock is not going to fall back, you could take this and then drag it up to where you want to buy, let's say 128.52, and then you will release and then hit buy. Okay. But we want to keep it at 128, and we'll see if this thing comes our way because we don't necessarily want to chase this thing. Okay. Now, at the bottom, you can see the activity for the day. So you can see at its peak, with us coming to the downside, was at 14.13. You can see our peak to the upside or peak movement going up looks like it was about 14.06. So approximately 206. So right now we are at 2:45 p.m. And so if you do your military time, that's what we're looking at here. Okay. So again, now this thing looks like it wants to go up. So let's say, you know what? I think this thing is going to keep moving to the upside. Then what you can do is you can slide this thing up if you want to. If you want to be a little more risky, you can slide it up. Okay. But that's entirely up to you. So let's go ahead and just get in for this example's sake. Let's just bring it a little bit lower there and see if it's going to get us in. And then if it gets us in, we're going to set up an automatic to take profit. Okay. So now you see we're in. So now we can go ahead and put a sell order in. So we hover there and say we want to sell it at 128.80. Okay. And let's see if it raises back up to get us a 9% profit. Now, one of the reasons why I like trading stocks inside of WeBull is because they're actually free to trade. When you get into options and you're trading, calls and you're trading puts, what can tend to happen is you're going to be charged a fee for every option that you would potentially buy. So, for example, if I come over here and I go to options trader, for example, right? And let me scroll this in a little bit. So if we go to options trader, and for example, you can see that the current price, and let me slide this down for us here. It's right there. Let's say we wanted to buy a, let's see, I don't, let me change that. That's not right. So we're going to change that to single option. So let's say we wanted to get in for $760. Okay. And so let me see where, let me take that off and we can break it down. You can see that transaction fee, they would be charging us 13 cents just to get into that thing. Now, you'll notice with some of them, they'll charge you $1, $2, $3, depending on what kind of stock option you're going with. So you got to be careful with that. Now, even when it comes to futures, they may charge you a couple bucks as well. And so this is one of the reasons why I like to trade stocks outright. Okay, that doesn't mean that you shouldn't trade options because I do sometimes. I just don't trade them a lot. Okay, so you can see right now we're down a little bit as far as profit goes. And so sometimes, I'll do something like, all right, well, let me just buy another share to kind of average things out and then eventually come back out on profit. So we'll see what happens over the next few minutes or so. So we're still waiting to see if we can get some sort of profit. Now, for example, if I said, you know what, I don't like the direction this thing is going and I want to get out of this trade for a loss, you can drag it down to wherever your stop loss, where you want your stop loss to be. Let's say if you want it to be 128.34, you could drag it and then hit sell. But we're gonna cancel that because we're gonna see if it comes back up or not. Okay. So hopefully you guys are kind of seeing, my thinking here, the way I like to move with this thing. And now these candles are really showing us a little bit of movement to the downside. And so overall today, I'm still up almost 1%. So what we're doing here is not really having an impact on, what it is that we want to do here. Okay. So now you guys can see we're at a point where I have it set to where I'll just get out of this position if it comes. So this line here just represents, hey, this is kind of my max that I'm willing to lose in this particular trade. And so what I could do is take this thing here, all right, and we're gonna slide it all the way down, and we could release there. But I still want to see if this thing is going to pop back up. But as a visual, I can see where I'm just like, okay, I'm out of this thing. I don't want to keep playing with it if it comes down to this point. So we're gonna see what happens over the next few minutes or so. So now we're approaching the area where we actually purchased the stock. And so if we come back to this area here and we get rejected, then we're probably going to come down a little bit further, which ultimately would be about testing this particular line that I have here as a floor of support. So we're going to keep our eye on that and hopefully we can make some kind of move soon as it's a pretty flat day right now. All right, so we just got stopped out. So we took our little couple of cent loss there. But let's go ahead and dive into some more important things. So we got you guys off to a good start of how you can begin to day trade here. But let's go ahead and talk about some things. So we're gonna talk about flash crashes, and the reason why this is important is because this can happen at any given time, and this is why it's important to use your stop loss because it can come out of nowhere. And I'm not saying this to scare you guys or anything like that, but this is something that you must be ready for. Now, let's talk about how a flash crash occurs. Okay, and so we can see that automated trading algorithms execute large volumes of trades rapidly. Also, high frequency trading, which is also known as HFT firms, contribute to volatility by withdrawing liquidity. Now, liquidity drought, sudden lack of buyers slash sellers exacerbates the crash. So, market fragmentation, the discrepancies, in price information led to chaotic trading. So, all of this in a nutshell is really how these flash crashes take place. And so, for those of you that don't know what a flash crash is, basically, let's say you're in a stock that's worth $200, and then the next minute you look up, it's down to $175, and it can happen very, very quickly. So, again, this is why it's important. If you're going to be day trading, swing trading, any kind of trading, you want to make sure you use a stop loss or have some sort of way of hedging against your position. Okay. Now, there was a case study for the 2010 flash crash, which was on May the 6th, 2010. And here's the timeline. At 2:32 p.m. Eastern Time, markets began to drop. By 2:45 p.m., the Dow Jones plunges nearly 1,000 points. And then it says at 2:47, market recovers most losses. Look at all this that happens all at one time. And if we bring up a chart of the Dow Jones, for example, bring up Dow Jones, and if we go to 20, 2010, for example, so let's go max year out. 2010 is around here. So $1,000 back in that time frame is a lot of money. So just imagine the Dow Jones is even at $7,000 or whatever, right? And it goes down $1,000. That is a catastrophic move to the downside. So again, this is why stop losses are very important if you are a trader. Now, the aftermath of the flash crash is regulatory investigations by the SEC and the CFTC conducted in-depth investigations. And the reason why they do this is because they want to figure out exactly what happened and what was the cause of this flash crash and the manipulation that's going on. Okay. Now, new rules implemented. You've got circuit breakers to halt trading during extreme volatility. And then you got stricter controls of HFT and algorithmic trading. Sorry. Then you've got market reforms, emphasis on better coordination between exchanges. So, in order to prevent the manipulation that can go on and hurt a lot of people's financial future, they have to implement these regulatory investigations and put new rules into place. Therefore, these things won't occur like they did in 2010. Now, lessons learned from the flash crash: market vulnerability, exposed risk of high speed automated trading. Then you've got risk management, which we'll go more into depth in just a second. The importance of stop loss orders and disciplined trading. So, you guys notice in this particular video in the beginning, we had a stop loss where that blue line was that got us out when we needed to be out. Therefore, we didn't blow up our account. Okay. Now, psychological impact: traders need to be prepared for extreme volatility. Ongoing reforms, continuous efforts to improve market stability and transparency. Now, the legacy of the flash crash remains a pivotal event in financial history, highlighted the need for better oversight and risk management in modern markets. A reminder of the unpredictable nature of markets and the importance of staying informed and prepared. Now, to conclude this particular session, you've got questions and discussions. So, invite questions that you guys may have about this or any other uh, issues that you guys may be facing as a beginner. And so, let's go ahead and let's talk about stop losses more in depth because this is probably going to be the most important aspect to this video. All right, now let's go into risk management a little bit more into depth. Now I know this part is important, and for a lot of you, it may not be as fun to listen to, but you're gonna see what I mean when you get out there and you may lose some money. Listen, everybody that trades loses at some point. It's just about minimizing your losses, and you do that by using risk management, obviously with stop losses and other ways that are more advanced, and we'll talk about at a later date. Now, risk management obviously involves identifying, assessing, and prioritizing risk in trading. It's crucial for traders to protect their capital and minimize losses. Effective risk management ensures long-term survival and profitability. So if you want to stay in the trading game and you want to be profitable, you want to be in this thing for the long run, mitigating your losses are going to be very, very important. And I know it sounds like a game right now, but you guys keep trading, you'll see what I'm talking about. Now, understanding risk tolerance, right? Now, risk tolerance is your ability to handle potential losses in trading. Assessing your financial situation and emotional resilience helps determine your risk tolerance. Now, align your risk tolerance with your trading goals for a balanced approach. Very, very important, having a balanced approach. So you'll learn that there's a certain amount of money for you that's going to be max, right? And once you figure that out, then you can start to implement your plan and strategize what's going to work for you, what kind of stop losses you need to set up, and what are the things you need to do in order to not lose more than you're willing to lose. And along with that, the emotional aspect of this thing is I can't even explain it. It's just something you have to go through to know what I mean. So yes, when I started trading, 10 years ago, I had my ups and downs just as I do now, but my losses are a lot more smaller. I think the biggest loss I've had over the last couple of months has maybe been $40 in a day. Um, but yeah, that's not, I mean, that's not bad. I would say over the last couple of months, I average, if I do have a loss, is about $6 or $7. So I keep my losses very, very small at a point where I don't even really think about it. And also at the same time, I like to make small gains. That way, I just be consistent. What I know is going to work. I don't care if I get 5, 10, $50 as a win. I'm going to take it. Okay. That's another thing. Whenever you're in profit, just take it, or you'll find yourself being greedy and you'll see your account start to go down in value because you were being greedy, waiting on something that wasn't going to occur for you. So use your stop losses and take your profit when you see it. Now, positioning size also goes with greed. And so for me, I like, let's say if I have $6,000 that I'm trading with, I may only trade, you know, $300 per trade with a tight stop loss to lose no more than, let's say, $10, right? So you have to do what works for you. Now, position sizing determines how much capital to allocate to each trade. Now, the 1 to 2% rule suggests risking no more than 1 to 2% of your capital on a single trade. So if you've got $100, you don't want to be trading more than $2 at a time. And so I would say when you're starting off, if you got $100 and you want to trade $2 at a time, you may need to go with a brokerage like Robinhood that allows you to trade as a little as $1 per trade. So that's maybe something you want to look into. Now, proper position sizing helps control risk and prevent significant losses, which you guys will learn. So, for example, if I have $10,000, right, and I use $2,000, I'm more prone to losing more money by using 20% of my account at that particular time versus using 1 to 2%. So if you got $10,000, maybe play with 100 or $200. That way you'll live to see another trade. You won't blow up your account, and you know things will just work out better that way for your overall health. Okay. Now, setting stop loss orders, we kind of talked about that in WeBull. It's very simple to do. It's just a tool that you must use. Now, a stop loss order automatically sells a position which it reaches a predetermined price. It's a critical tool to protect against large losses. Types of stop loss orders include fixed and trailing stop losses. So you saw a little bit of that in the beginning of the video where in the tab that was trade, that's where you can set up your profit that you want to make, and then your stop loss. Now when we slide the particular plus sign up and down, that's kind of more so known as a manual trailing stop loss, but there are automatic ones you can set up too. But for me, if I'm gonna do something like that, I'm gonna sit and watch, and I'll be the person that kind of controls that, not necessarily algorithmically. Okay, so you set stop loss levels based on volatility, support, and resistance. We've already covered that. Now, diversification also another good thing. And when we talk about diversification, that's basically saying that I'm not only trading one particular stock, although for me, I would say in the beginning, you can do that until you learn the ropes and do very little amounts at a time so that it clicks that so you learn. But diversification is very important, especially when you start to get a little bit more advanced and you're doing different things, doing different strategies, something advanced like a call credit spread or a put credit spread or debit spread. That's when you want to start to be a little more diverse. Now, diversification spreads your investments across different assets to reduce risk. So, pretty much, this is saying not to put all your eggs in one basket. And this is one of the ways you can do so. Now, it minimizes the impact of a single underperforming asset on your portfolio. Okay. Diversify across asset classes, sectors, and regions for optimal risk management. All right, so let's move on to risk reward ratio, which here's where that greed can kind of come in handy. And for me, I've learned, guys, if I see green, I'm out. I'm done. I'm not sitting there playing games. I mean, if it's running, I'll look to see if it's gonna run a little bit more, but I'm in and I'm out. I'm not playing those games. Now, the risk reward ratio compares the potential profit of a trade to its potential loss. Aim for a ratio of at least 2 to 1 to ensure profitable trades outweigh losses. Okay. So consistently applying a favorable risk reward ratio is key to long term success. So for me, I usually say my rule of thumb is really to try, and this may not be a lot for you guys, but I try to get to a 0.5% a day to the upside. Okay. And by that, to the downside, if I lose a 0.5%, I'm not swayed one way or another. So, for example, if I have $1,000 to trade and I lose $5, I'm not really up in arms about it. At that point, it is what it is. So, the more riskier you are, the higher your reward could be, but the higher your risk is as well. Okay, so you can't be so optimistic that you can't see what could happen either way. Now, avoiding over trading. Now, over trading is executing too many trades, often driven by emotions. That's very important too. So a lot of times you'll be up for the day in a particular trade, and then you go in again and go in again. Next, thing you know, now you're down because you're over trading. You were already in the green. Now you're feeling yourself. The portfolio's looking green. Now you want to see how far you can go, and the markets will show you. So take your profit and run. I'm telling you guys. Now, it leads to increased transaction costs, especially with those option trades and higher risk exposure. Avoid over trading by sticking to your trading plan and trading and setting trade limits. Now, regularly reviewing and adjusting your risk management plan. Now, regularly review your risk management strategies to adapt to changing market conditions. Monitor your performance to identify areas for improvement. Very important. We're this is a continuous cycle that we learn in, guys. Even though I've been doing this for 10 years, I'm still learning. You still learn from your mistakes, and you just got to keep going and apply what you've learned, not ignore them. Okay. And then you want to stay flexible and make adjustments as needed for continued success. Now, to conclude with this section, risk management is essential for protecting your capital and achieving long term trading success. Commit to continuous improvement and stay disciplined in applying your risk management strategies. Effective risk management is the cornerstone of a successful trading career. So, there is a stat that I'm not really going to talk about, but it's a very, 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 very small percentage of traders that are actually profitable. Um, I, I'm fortunate enough to be in that particular position, but that's only because I'm disciplined and I just don't like to play too many games, and I just take what the market gives me. Now, if you want to be greedy and you want to get emotional and you want to try to get your get backs and all of that, it's only going to put you in a deeper hole. Now, yeah, some people have beginner's luck right out of the gate. They'll put $1,000 in on a call, and that thing can bring their account value to $10,000. But because they didn't learn anything in the process, eventually they'll go on to lose all of the gains that they have. And this is why it's a teeny, 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 tiny percentage of traders that are actually profitable. Now, there are other safe haven ways that you can go about trading, which we'll talk about in a later video. But overall, today, I just wanted to get you guys going in the right direction by going long, meaning you're trading to go up with a particular stock. And so the next video, or I don't know, within the next couple of videos, we'll talk about trading ETFs that go down when a stock goes down. So, for example, if we were trading NVIDIA, there is an ETF that tracks the downward movement. So you make money as NVIDIA goes down. Now, you can do a put option and ride the wave down. But if you don't want to play those silly games and you don't want to have a transaction fee cost, then I'm going to show you how you can make money when a stock goes down, especially tech stocks. Okay. So listen, guys, I appreciate you guys for rocking with me today. Please hit that thumbs up, share, subscribe, and we're out, guys. Peace.